Hi, friends. It's Amy Ruiz with Keller Realty, and I'm here today with my lender, Ruben Madrigal. Ruben, hi.
Hello, everyone. Thank you, Amy. Yes, I'm Ruben Madrigal with Fiducia Home Loans.
Ruben, the reason we're here today is explain to people that are thinking of buying a home, the Fed cut 50 basis points. But what does that really mean for a home buyer? For somebody who's thinking of maybe jumping in and getting a loan to buy their home?
Yes. So the Fed's cut what's called the Fed funds. And the Fed funds are used to loan money to banks for short-term loans. So it's money from the Feds that the banks go borrow from. And short-term loans are car loans, credit card loans, home equity lines of credit, commercial loans, and mortgage arms. So it's a great indication to what's going on in the market because we've had 525 basis points increase from 2020 to 2022. And the reason they did that is to cool off the market because there was just way too much borrowing. Inflation was over 9%. So by increasing the rates, the consumer would borrow less and will cool off the market. And that's exactly what it did. And now then they have the numbers showing that we're trending in the right direction. They're starting to lower Fed funds. Now, that is not attached to 30-year mortgages, but it's a full economy. So by them lowering the Fed funds, it will eventually cross over to mortgage interest rates.
So that means
So
that interest rates didn't go down right now, right?
they actually went up a little bit, slightly, and mortgage rates have been down over 1% in the last 6 months without the Fed doing anything because automatically the market had already been trending that way. So in the last 6 months, we naturally seen mortgage rates come down without the Feds doing nothing. Okay. Normally that happens because there's indications that the market's heading in that direction. This thing's starting to slow down. Unemployment rates go up. CPI numbers, which is the consumer pricing index, they track everything we buy. You know, if we're not spending money, the market is slowing down. And when they see that happening, then the 10-year treasury bonds, the pricing on them start moving downward. And that's what's attached to 30-year mortgages. And that's where we start seeing it go down. So my expectation in the 20 years I've been doing this, by tracking the 10-year treasury yield and the Fed funds, they very closely follow each other. So having Fed funds go down, more than likely we will start seeing the 10-year treasury note also move in that direction and lower interest rates. So if somebody's thinking of buying, let's say in the near future, I would jump into the market now before rates go down even more and you get more buyers into the market. San Diego is really hot when there's a lot of buyers. It gets crazy and you're overpaying and waiving all the contingencies. You could talk more about that, but you can always refinance, honestly, as long as you take care of your credit and you're in a financial position to refinance.
You're right. I think a lot of my friends are thinking, I'm just going to hold off until interest rates come down. Honestly, everybody wants to see them back in the 2 and 3%, which I think they will ever go back down to that. Friends, if you're waiting to buy right now, like Ruben said, is the best time. Because if you wait to buy and interest rates go down to 5%, and that's when you're going to jump, along with a lot of other buyers. And what's going to happen is now you're going to have competition. And like what Ruben said, you're going to have to waive loan contingencies, appraisal contingencies. And that house that right now you may have very little to no competition on a house that you like. Later on, when the interest rates are low, you're going to have competition with 3, 5, 10 buyers. And what happens then? The price on the home goes up, right?
Right. I've seen two things in the last 12 months or 12 to 24 months. Customers that purchase are returning and we're refinancing them. And on average, we're saving them anywhere between $400 to $500 a month. Also, those homes they purchased in the last 6 months to 24 months have gone up in value. So if they waited to buy now, they would be paying more for that home. And lastly, what I've seen is when you get into a market where it's low, you can ask for credits. They can go towards your closing costs, your interest rate. So I had a lot of my customers got those 2-1 buy downs And so they were actually really comfortable, and now we're getting them out of the buy down into a permanent lower rate.
Fantastic. Well, sounds like we have a couple more videos to make to explain that a little bit more, because that's another great way of getting everybody into a home without having that higher interest rate. We could just kind of temporarily lower their monthly payment until those rates come down. So friends, if you're interested, Ruben is a master at looking at all your options. What can you do now? What can happen later? So give him a call. Ruben, do you want to give everybody your phone number?
Yes. My phone number is 619-817-5889.
Folks, and give him a call or give me a call at 619-328-6648. And I will put both of our information down below the video. So look for that. Reach out to either one of us for more information, and keep an eye out, because we're going to be doing a lot more videos on loans. Ruben, thank you so much.
Thank you, Amy. Have a wonderful day, everyone.